Okay, happy 2026, everyone, and welcome back to Bitcoin Capital. Today, we're talking about security, tokenization, and real-world assets. I think this is one of the big themes of 2025, and looking forward to the next 12 months, I think it's set to get even bigger in 2026. The idea of taking the technology behind digital assets and applying it to capital markets, I think at a high level, is relatively straightforward. But when you dig down deeper, there's a lot of slightly competing approaches being taken. At the regulatory level, there's the cautious, slow moving approach from major capital centers. It's kind of dominated by the incumbent players of TradFi. And then there's also the more crypto friendly approach being taken in places like the UAE, in El Salvador, Central Asia, and even parts of Europe. At the protocol and maybe the platform level, I think there's also a spectrum that runs from what I see as kind of the Wild West approach that leverages the technology to convert securities into kind of bearer assets. And that runs all the way over to what the big banks are doing that I'm not even sure is actually tokenization. So I think there's a lot of consensus in the headlines. Everyone expects security tokenization and real world assets to get bigger, but digging down deeper and looking into the trenches, I think there's quite a bit of experimentation and competition. So to better understand this, today we're speaking with Carlos Domingo, the founder and CEO of Securitize. Carlos, welcome to the show.
Thanks for having me. It's my pleasure.
Great. Now, to start off with, maybe we can set the table for today's conversation by doing a quick introduction to Securitize, letting us know, what is the business that Securitize does, and who are the issuers and the investors that you guys interact with?
So we are a tokenization platform, arguably the largest tokenization platform in the industry. So what we focus on specifically securities. You can tokenize many things. You can tokenize dollars, that's our stable coins, commodities like gold. We focus on tokenizing securities, which means, fund interest, bonds, equities, etc. We focus on tier one issuers. So our strength is into working with large financial services companies and asset managers, the likes of BlackRock, BNY, Vanek, Hamilton Lane, KKR, etc. Apollo. And then from an investor perspective, most of the RWAs today, the tokenized securities, are being consumed by crypto institutions. These are, protocols, foundations, hedge funds, credit funds, etc. within the crypto ecosystem that are consuming, tokenized securities for a variety of use cases. There's collateral management or treasury management, to back some other, earned products or stable coins, etc.
Well, that's interesting. I would have expected that the investors would have been the normal kind of crypto investors, or maybe kind of slightly more, technology savvy securities investors. But the investors primarily are these protocols.
There are, most of the products we have today are, institutional products. So they are not for retail people. We're now kind of starting rolling out retail products that are available for retail people. So we hope that this will trickle down to crypto investors. But look, the reality, obviously, the ultimate goal is that tokenized securities and RWAs are being consumed by any single investor, right? Because that's where the total addressable market becomes, 100 times bigger than it is today. But the reality today is to interact with the assets, you still need to have some degree of crypto savviness, right? You need to be able to create a wallet and receive the tokens, approve transactions, deal with stable coins. If you want to interact with the tokenized asset in a DeFi protocol, then you need to how to deal with a DeFi protocol, etc. So I think that we're still in a place where crypto people are crypto savvy with all the tools required to interact, and that the technology is not abstracted out enough for normal investors to be able to consume it.
And what is the bottleneck, you think, for the normal investors at the moment? Is it a regulatory issue primarily, or is it a demand issue or an awareness issue?
It's not a regulatory issue at all. I think these things are very, the regulatory framework of tokenized securities and RWAs, I think, is well understood, and everything we do is obviously what we do, at least. I'm not speaking for others, but because this is crypto and there's all sort of shenanigans happening there, as you can imagine. But we are a regulated entity with the SEC. We work with very large financial institutions, so everything we do is legal and regulated, and that's not a problem. I think it's a combination of, first, lack of understanding of crypto and the crypto tools required to access crypto-based products like tokenized securities, as well as obviously awareness of what this products, the advantages of these products bring. But this is fine, right? So look, this is like when the internet started, connecting to the internet was complicated. You needed to download TCP/IP and modem software and had a hardware attached to your computer. And, only the early adopters were adopting the internet. And then at some point in time, it kind of became transparent to use internet, right? Now everything, it's there. You open your laptop or your phone and works, right? So I think blockchains are moving towards that direction. And I'm assuming like you, many years in the industry. So the user experience today, is like significantly better and easier than it was today. There's a lot of wallets that are very, very easy to use, right? So as these things get better and get more integrated with the endpoints that people use to consume products, then, the products will, start being consumed by normal investors.
And what is your background? How did you find your way into this space?
Actually, a lot of people think that I'm either coming from like Wall Street or capital markets, or I'm a regulatory lawyer. I am not. I have a PhD in computer science. I came to this through the technology. I was actually interested in technology generally and stumbled upon blockchain in 2016 during the ICO times. I participated in some of the early ICOs. One of my friends, actually, we were talking before starting the call that I'm using the Brave browser. So I'm a big fan of Brave, the company, and the browser. And I've known Brendan Ike for many years. We interacted a lot, did a project together when he was at Mozilla. So I think that through Brave and their ICO and some other ICOs at that time, like, Aragon and others, that friends of mine were doing, that's how I got exposed to the blockchain technology and crypto space initially. And from then, it kind of became kind of obvious that, this technology applied to traditional financial products has the potential to improve how you invest and how you deal with like illiquid assets and stuff like that, right? And even though I'm not a financial services person, but as an entrepreneur and a tech person, I've always been investing in funds, in buying equities and investing in startups, etc. So I came from the technology angle of it, and then obviously I had to learn the hard way about how complicated the other part of capital market structure, regulations, etc. is, because
turns out the tokenization part is the easy part.
Yeah, so it's not unfortunately, it's not just a technology problem, right? So and this is why this has probably taken longer to take off than other parts of the industry, because it's a combination of, yes, you need to have the technology and the user experience and everything working, but at the same time, you need to have the right, kind of like licenses and regulatory framework and understand how to operate, etc.
So what was your experience like after that ICO boom? I suppose there's probably people in the market now that didn't even, kind of get involved in that ICO boom, or maybe one or two cycles later. I can remember during the height of that, I had an opportunity to have a dinner with Vitalik Buterin, and he said, at the time, I remember him saying that he thought 98% of the projects were going to fail. And I was completely new to VC investing. I had a background in investment banking and equities, and I said, 98%? No, he said it's a little bit high. Surely it can't be 98%. But, maybe that even proved to be low in hindsight. So did your conviction wobble at all after that correction in that market? Or what did you see that was interesting with the ICOs? And then did that impact your conviction afterwards?
So first, I think that 99% of startups fail.
Yeah. So it should be natural, right? Yeah.
It should be natural. I think what the ICO mechanism of how companies were raising money and how that became very quickly liquid was kind of compressing the cycle of a startup, right? Like in a normal startup, like we're an equity-based company, right? So we had to go through the normal like startup life cycle. You raise seed capital, you make a little bit of progress, then you raise your Series A, you make a little bit more progress, then you raise your Series B, you make a little bit more progress, and then at some point in time in the middle, if you're not making progress, you're not able to raise the next round, and you die. I think the ICO kind of compressed this because companies were raising a ton of money very, very early when the company was still in very early stages. So they actually had more capital that they should, in my personal opinion. I think there was a toxic component of companies being able to raise too much money too early, which is counterproductive sometimes for an entrepreneur, because it doesn't put you in the spot of trying to, maximize how much progress you're going to make with the amount of money you have. And then at the same time, these companies became kind of sort of publicly traded, if you want, right? Because their token became liquid and people could buy and sell it. And that also created, in my opinion, a very toxic environment sometimes, because of projects that were not necessarily making any progress. They had a liquid token that was trading and that had a certain market cap, and the companies quit for like years. survive. There's so many, even though most projects fail, there's also a lot of like zombie projects in crypto that don't die because the token is still out there. There is a certain amount of trading volume, so they could keep selling tokens and fund the business, and they never die. With normal funding cycles, this will not have happened. Like there is a lot of projects and even chains out there that under normal funding conditions, these projects will be dead already because they will not have been able to continue investing given the lack of progress, right?
And there was also a lot of bad actors too. So I mean, I think there was a lot of so that's what I mean. I mean, did coming out of that, did you feel, was your conviction, with this thesis that you had that this could be applied to capital markets, did that wobble at all, or did you just think that there were some pieces missing and it needed to be tweaked and we could still make this work?
So you're right. This industry, because of the nature of moving, dealing with money at the end of the day and dealing with things that had monetary value, and then the fact that it was completely unregulated, and it is still largely unregulated, at least the parts of not the security side of things, but the rest of the parts attracted bad actors because there was an easy path to make money, and because also these offers were available to retail people that are not necessarily sophisticated. That also created that situation. People could take advantage of that in traditional markets because offerings of financial products are regulated. Then it's much harder to create so many scams because you at some point in time you're going to be blocked by regulators, and regulators got a lot of scams, right? But they also missed a lot of them, unfortunately. So yeah, yes. So during these years, I think especially for me, if I think about like the 2021 time, was perhaps when I felt more concerned whether this was going to happen or not, right? Because at the early days, like yes, the 2017 everything went up and then it crashed in 2018. But I was starting the company, so I still have like thinking, well, this is going to take a few years, and then by 2021, things were still not happening, and at the same time, the kind of unregulated side of crypto was exploding, right? Like I remember I was trying to raise my Series B, and I will talk to an investor and they'll tell me, oh, but look at BlockFi, how much is growing, or Terra Luna, or like Celsius. Is like, of course, they're doing illegal stuff. That's very easy to make money. But I'm trying, and of course, legal stuff and regulated stuff, it's harder. So it takes longer to just basically and do it, and requires more time and more capital. So I was feeling like I'm never going to be able to compete with these people that are basically doing illegal stuff, but they're printing money. And then, to be honest with you, now after that, I felt vindicated because all those companies, went out of business. They're worth zero. My company now, it's actually doing well. We're going public, as you know. So, but it required a lot of conviction over the years to stay in business, looking how people just took the easy path of, okay, let's do regulatory arbitrage or blindly break the rules and start making money while we were not making money. So.
Yeah, and I think a few years ago, the idea of bringing securities to blockchain, to tokenizing securities, it was still seen as kind of a wild idea. So it must be encouraging now to see that consensus has kind of caught up with that idea that I guess we had at Bitfinex Securities and that you also have at Securitize.
Yeah, I remember when you guys created Bitfinex Securities.
Yeah, so that must have. So it's encouraging to see that the consensus view and big players like BlackRock and BNY and all of these guys that are pretty vocal about it now to kind of see the value in the industry.
I think, yes, it took a number of years for two reasons, I would say. One is there was first the infrastructure, as we discussed at the beginning, was very bare bones and was, it was not there yet. So that improved over the years. Second thing is that for large companies like like a BlackRock or a BNY to enter the space, they have to feel comfortable that what they're doing is 100% legal and regulated, right? And then there was not many intermediaries, like you guys got a broker-dealer license, I remember, and we did as well. And there were many others that got transfer agents or broker-dealer license as included. And that gave kind of like peace of mind to these people that you were regulated, and therefore what the activity you were doing was legal. And then, but also required to have internal conviction, right? Like not everybody did what BlackRock did or what BNY did, or Apollo or Hamilton Lane in the early days, etc. Like there's still a lot of companies that are looking on the fence. And I think the other thing that happened was, as we discussed, the shifting in narrative in the crypto ecosystem, right? Like after all this debacles that happened in 2021, 2022 with all these companies going bankrupt and all these people going to jail, etc. I think people realize that, collectively we've built really valuable infrastructure and technology, but we need to apply it to real world uses. And this is where the terminology of real world asset started, which didn't exist when I started the company. This is a new thing. The last 2 or 3 years, that term has appeared. It used to be called
STO.
STOs, exactly. So I think that confluence of things happening there at the same time is what has, and then obviously, since Trump took over the U.S. administration and the change.
Well, that was the big one, I think, was the ETF, right? Once the ETFs got approved, then it just seemed like that really, released all this pent up institutional interest. And then they started looking, to other ways that they could kind of, work with the technology and follow up on the ETFs, I think.
If you want to pick a point in time, in my opinion, that shifted the industry was Q1 2024. Because in Q1 2024, 2 things happened. The Bitcoin ETF, and then BlackRock's IBIT exploding in size, and then BlackRock releasing BUIDL, the tokenized treasury fund. Those 2 things happened the same quarter. I lived and breathed that because I was part of one of the 2 projects. And I think that quarter completely changed everything, right? It put, Bitcoin in the spotlight for traditional investors and through the ETFs. And at the same time, it put tokenization and RWS in the map, with the largest asset manager coming very strongly with a product that very quickly grew very, very large.
So what is the model for Securitize now? I think there's a couple of different parts to the industry. There's, there's legal and structuring, there's the actual tokenization and token management, there's facilitating capital raises and trading, and then I guess maybe distribution rolled up in that. What parts of these businesses do you guys do, or do you take a vertically integrated solution and do it all?
I mean, we don't do the legal structuring in the sense that we are not a law firm, so we will work with law firms to do that. We can support the legal structuring because we are an investor advisor. So in some cases, we actually manage the asset, the tokenized asset, on behalf of our customers with an investor advisor license that we have. And then we participate in the rest. So we are the manager of the securities, if you want, as a SEC registered transfer agent that involves the tokenization platform to issue the tokens on chain, and all the downstream integrations we have with different parts of the crypto ecosystem. And we're also a broker dealer and ATS, so we can do both distribution and secondary market trading. And I'm a big believer on this approach of, and recently we bought a fund admin business. It was almost a year ago now, not that recent anymore, but to be able to do also fund admin for the tokenized funds, which is important. And I'm a big believer on this kind of integrated approach, because many, many years ago, I think it's like more than 25 years ago, I read a book called Crossing the Chasm by one of the innovation scholars. It's a guy called Geoffrey Moore, who used to be really, really famous. And then that book, it talks about how these early stage technologies that they get traction at the beginning. So people think that they're being adopted, but they're really only adopted by the technology enthusiasts, right? This is like crypto and Bitcoin at the beginning. It was only the geeks and the super techie people that were actually buying Bitcoin or participating on the ICOs like me, right? So, but then if you want to move mainstream to the rest of the population that are not these technology enthusiasts, they're not early adopters of technology, etc. What they need is a whole solution. You need to give them a product that they can just take everything at once without having to somehow build the solution by choosing best of breed in each part. Once industries mature, then that breaks apart, and then people have best of breed solutions that they integrate with each other well. But today we're still in the early days of the industry. So I do believe that a vertical integrated approach, where we go to a company and we tell an asset manager, a bank, and we tell them, you do your job of being an asset manager and manage the asset, and we'll take care of everything else. We'll put it on chain, we'll help you structuring it, we'll distribute it, etc. You don't have to worry about anything. That has turned out to be the right solution, and what gives us a competitive advantage in the market compared to other people.
So you mentioned before that you guys are working on a SPAC listing, 1.25 billion. Will you have a tokenized component to that?
Correct. We've announced as part of the SPAC announcement that we're going to tokenize our own equity. I'm a big believer of leading with example. People ask me, like, why, if you tokenize securities are so good, why are you listing in traditional markets? Well, I still think that, while I'm a big believer, obviously, of tokenized equities, and we're going to tokenize our own equity, the market still doesn't have the depth of liquidity that traditional markets have. So I do think that for the foreseeable future, we're going to see the two markets coexisting, where companies will have a public listed security in the traditional markets, where there's New York Stock Exchange or NASDAQ, where it trades there with the traditional players through the traditional intermediaries, blah, blah, blah. And then you're going to have a portion of it that is tokenized, that is being traded by the crypto savvy people in crypto protocols, and with self-custody wallets that will trade on decentralized exchanges, etc. So I think those two things will coexist for a period of time, and hopefully one day the on-chain version becomes bigger and the other one disappears. But I don't think it's realistic to think that's going to happen the next 5 to 10 years. There's too much infrastructure and too many people participating in traditional capital markets to be able to displace them overnight.
100%. Yeah, especially is your focus kind of in the US, or where do you focus, or is it global, or how do you kind of see your positioning there?
I mean, I like to think that our company is global and I want to build a global business. I'm from Spain, I live in Florida, but then we have people in the company from many, my CFO is from Mexico, my chief of product lives in Madrid, we have engineers in Argentina, we have people in Japan. So I want to build a global product, a global company, and I do believe that this technology kind of helps abstract out the local regulations and make it, financial services products more accessible globally. But we took the decision, which seemed to be the wrong decision for a long period of time, of starting in the US. And then getting the licenses here and getting regulated here and building the business out of the US. And the reason was very simple. People don't realize that capital markets, the US is so huge and dominant. It's like 50-60% of the entire world. Their capital markets are in the US. And then the second player, if you take China out for a second, then is Japan, that only has like 5% market share, right? So it kind of drops very dramatically when you move out of the US into the second one. And then the rest is like a very, very long tail of countries, which, by the way, they have their own interest. Emerging markets like you guys and with Tether are extremely successful distributing dollars there. And I do think that there's something there. But from a more mature capital markets perspective, the US is where you need to be. That's where the action is. That's where the largest companies, asset managers, the largest pools of capital, etc. Everything is here. So,
in terms of adoption, though, I think that's probably where where you see the final stage of adoption, where everybody's using tokenized securities. That's probably where the incumbents will be strongest and kind of hold on the longest. Do you think, kind of in the bigger markets, Tokyo, City of London, Wall Street?
So it's going to be interesting now that we have regulatory clarity in the US, how the incumbents start like moving towards the space, right? Like so far, the incumbents have to stay largely outside, with the exception of asset managers that were, I think an asset manager kind of understands better the advantages of the technology, in the sense that they manage large amounts of, securities. And then they do know the inefficiencies of how those securities are being managed, right? So they get the advantage of tokenization faster than other parts of the value chain. But it's going to be interesting to see how incumbents in different parts of the value chain react. Like we saw recently some announcements from DTC about tokenizing entitlements. We've seen obviously now some of the exchanges, NASDAQ, New York Stock Exchange, looking at what to do. You have now the banks that are more actively participating, doing tokenized deposits and doing other things. So it's kind of going to be a very interesting next 5 years of this confluence of the TradFi people and incumbents coming into a space, and the startups like us trying to build.
Yeah, I think our kind of view is we've taken a different approach, where we're kind of working it from the outside in. We're following kind of the Tether model and working from kind of emerging markets and coming, hopefully eventually working towards the more mature markets. And I think you can definitely see a situation where in a couple of years you've got kind of competing ecosystems and different experiments playing out. But yeah, I think that's really interesting. I think also, if there's an ability to allow conversion between conventional securities and tokenized securities, I think that's also super interesting. Because if you ask investors, like, why does Bitcoin dump on the weekends? It's because, markets are closed, right? Like people would love, and that's why you have things like ADRs and GDRs, because people want to trade TSMC at 9 a.m. in New York, right? They don't want to wait for markets in Taiwan, where I'm based, to open up. So I think if you ask investors, they definitely want to have those features. But as you mentioned, as industries mature, they become kind of fragmented, and people get different parts. You get custodians, you get like payment agents and transfer agents, and all of these things have their little slice of the capital market ecosystem, and will probably naturally want to push back a little bit to maintain their revenues and their profits.
Correct. So if you are a traditional intermediary, there's kind of like two scenarios here. One is you disappear, like you're part of the market, just simply gets eliminated. Like in my personal view, and I know this is going to be a controversial topic, but the part that a blockchain eliminates is the clearing and settlement, right? Because the clearing and settlement happens on chain, so there's no need for an intermediary to keep track of those things. So central securities depositories are probably the most impacted, and this is why you see them now trying to become active, to try to kind of defend their territory by doing things. And then the other intermediaries, like say a transfer agent, I don't think that they disappear. You still need a regulated entity issuing securities, but they get transformed. Like how they make money, it's completely different, right? This is similar to what happened with what the internet did to music, or to some music distribution didn't disappear, but the intermediary, how they make money changed, right? And new intermediaries that were doing things in a different way under a different business model appear. So I do think that on that part of the value chain, you will see, the kind of the modern version of the intermediaries that still are there, but they make money in a completely different way and they operate in a very different way. I'll just give you a very simple example. So transfer agents actually make money with, when a dividend is being paid, the dividend doesn't necessarily reach out the investors immediately, because the transfer agents actually don't know who the investors are. Because there is a web of intermediaries that keep track of, the entitlements and the DTCC, blah, blah, blah. And then the people don't, like, if you're a company, like I'm going public now, and I don't even know who are the investors in the SPAC because it's not public information, it's not accessible to me, right? So then, because these dividends don't get paid out quickly, they sit in the bank account of the transfer agent, and transfer agents make money with that, because they just keep the interest. Seriously, this is actually true. And it's not an insignificant amount of money. Now, on a blockchain space, in a blockchain-based securities world, where you have, the beneficial ownership in real time, because you have a ledger where you see the balances of each investor in real time, and each wallet belongs to one investor, and this investor has like 5 shares or 3 shares or 7 shares. If you want to pay a dividend, it's just basically a blockchain transaction to distribute stable coins to each wallet, pro rata to how many they need to get. And we do pay daily dividends for the BlackRock Beetle product to the wallets directly. And we've paid 100 million dividends since the product started, and we've never had any reconciliation issue. The dividends get paid immediately the moment they need to go, on a daily basis, etc. So on that scenario, if your business model is to make money on the float of unpaid dividends, then it goes away. So you're going to make money somewhere else. Then transfer agents also make money by facilitating transfers of securities. Well, on the blockchain, securities get transferred by themselves, right? Like there's no intermediation. Like in our system, when you hold, like say a share of, let's say in the future, a tokenized securitized share, and you want to transfer to another whitelisted wallet, it's just a transfer on the blockchain, right? There's no intermediation that we do. So we don't charge for it, and nobody gets paid, because nobody is intervening to make it happen. So that's another source of revenue that a transfer agent has that is going to disappear. So I think those intermediaries will not necessarily disappear, but they will have to be reinvented, how they actually operate and what they do, because many of their sources of money, of revenue today, will disappear.
Yeah, I think definitely there has to be some degree of disintermediation to kind of get to the efficiencies of the blockchain. I think it's just something naturally that has to happen.
Disintermediation or re-intermediation with more efficient intermediaries. Like, look, when I started in the industry, that's when internet started, right? Like I'm that old. So when the internet started, people thought the internet was going to eliminate intermediaries, because that was the thing, right? Oh, we're gonna be able to communicate without the telcos. We're gonna be able to distribute news without the newspapers, and we're gonna be able to do this and that. And then that didn't really happen, right? Like what the internet did was to kind of create new intermediaries that are much more efficient, that the products are free or much cheaper, that the user experience of the products is much better. So today, we don't have necessarily a more decentralized world because of the internet, but we have a better world. You and I are now speaking, over the internet. you guys are using StreamYard, but there's like 100 different providers that can do that. While in the past, this was like a monopolistic situation with the telcos only being able to do that. So it has opened up competition, and that competition creates better products and creates, more opportunities, reduces the cost of things, etc. But we're still going through intermediaries, right? To some extent, and to communicate on the internet. So I think that the same thing will happen here. I get the point of like eliminate all the intermediaries, everything is decentralized and free, and I think from an infrastructure perspective, that might happen, that the blockchain itself is fully decentralized. But on top of it, the applications will, unavoidably have to have some degree of intermediaries, but hopefully they're much better, they're cheaper, they're more efficient, they provide a better service, etc.
Yeah, and I think it's hard for securities to be completely decentralized. As you mentioned, like you need to know who's on your cap table, you need to know who to pay dividends to, and then you need to, you've got AML and KYC and all of these kind of obligations as well. So,
and by the way, stable coins to some extent, right? Like stable coins also have some degree of intermediaries, right? I mean, the issuer at the end of the day does have some. Well, it's a bit of a different thing because it's a bearer asset as opposed to a non-bearer asset. So, but you still have, if something happens, either Tether or Circle have the ability to freeze funds and or do things, etc. Right? And they still are centralized issuers from that perspective of the issuance of the stablecoin. But the stablecoins, and nobody disagrees, that are better than other forms of money, right? So you have not really decentralized, maybe a little bit, but you have kind of re-centralized with a better intermediary.
You mentioned bearer assets, and you mentioned whitelisting a couple of times. I'm interested to get your thoughts on this because I think there's different approaches being taken in the industry. I think there's some platforms that are actually have pretty decent scale that are probably pushing what I would consider to be the regulatory boundaries. How important is whitelisting? What is your approach to whitelisting and in your tokenization process?
You mentioned it, right? So securities, you need to know who is on the cap table because you need to pay dividends, you need to conduct proxy votes, etc. So I don't think that you can actually issue securities in a permissionless way that you don't know who holds the securities. I think that it's very hard for me to think in how this is legal. It's certainly illegal in the US, it's certainly illegal in Europe, it's certainly illegal in UAE, it's certainly illegal in Switzerland, in Singapore, in many countries. And the problem is that these companies and so that implies whitelisting, right? Because you need to know, who holds the asset. You need to make sure
at both the primary and secondary level. Do you mean if people take it off the platform, then that needs to be permissioned as well, right?
Well, if you take it off the platform, you're still holding the security, right? So what happens? So I don't get these people that say, oh, I will just whitelist on primary and then on secondary can do whatever thing. So what does that mean? It means that, okay, I'm going to go and buy, a tokenized, it's not even a tokenized security because what they're doing is tokenize something else, right? Like these are derivatives or wrappers or whatever. But anyway, I buy this tokenized quote security and I do KYC and they send it to me. And then I'm going to send it to somebody from Hamas. And then the guy from Hamas is going to send it to somebody in North Korea. And the North Korea guy is going to send it to a Russian oligarch. And the Russian oligarch to Maduro in Venezuela when he was still there. And then back to me because I'm KYC. Like, how does it?
Well, even worse for us is then you go from North Korea and then you send it to the US.
Well, exactly. So this is the thing. So better. I published recently something my team did, but it was I come up with the idea of doing it, of explaining that bearer assets for securities are either prohibited in many jurisdictions. They are like prohibited, explicitly prohibited, saying you cannot issue securities that are bearer assets, or they have to be immobilized. In other words, yes, you can have a bearer asset, but you're not allowed to transfer it. Or bearer assets are not explicitly prohibited, but bearer assets break a lot of other securities regulations, like AML, like insider trading, KYC requirements, etc. So it's not conceivable that bearer assets are going to be legal, even if you find some random jurisdiction, like I think some of the guys in the space, they're issuing it out of Jersey, because in Jersey, Jersey is this like offshore jurisdiction by the UK. Oh, in Jersey, bearer assets are legal. Yeah, sure, they might be legal in Jersey, but if there are bearer assets that are not immobilized, that are represented by a permissionless token that flows back to the US, you're breaking the law in the US. So why are you talking to me? Like, what you're doing is illegal. It might not be illegal in Jersey, but it's illegal in everywhere else where these people are consuming the asset.
So how do you think this plays out? Because there seems to be a lot of people that are really pushing the edges and they seem to be getting away with it. So how does it play out? Like my kind of observation.
Look, how this plays out, it's very simple. This is, I'm going back to you when you were asking me at what point in time I was losing conviction. So in 2021, I was actually trying to build, lending products because the interest rates for dollars for stable coins were very high, right? You remember at that time you could get, because crypto was booming, the people wanted to borrow stable coins, so you would get like 8-10% yields, and at the same time, traditional interest rates were like 0. So I was trying to build legal, products based on stablecoin lending, and then people were telling me, oh, but look, BlockFi is doing it this way, and they don't KYC, or the KYC is very light, and they have all these products, or they do it for retail, and you're not doing it for retail, or Celsius is doing this and that and that, and then guess what happened when those platforms became large enough? They either were shut down by the regulators, like essentially BlockFi was shut down by the SEC, or they just started doing shenanigans behind the scenes, and they collapsed like Celsius, right? So I do think that these products today are flying under the radar of regulators for the most part, even though I'm pretty sure the SEC is looking at it, because they're small. So these products are never going to work, because either they stay small, so it means nobody's going to care about them, or if they go big, they're going to get the attention of the regulators, and then at that point in time, they're going to shut them down because they're clearly breaking the law. I mean, there's nobody who can argue that these are not breaking US laws, or these are not breaking European laws, etc. So
yeah, I think that's kind of my observation as well, is that the regulators often take one cycle to kind of catch up with things. So they took them a cycle on ICOs.
And this is what the crypto, the unfortunate situation of crypto is that the crypto people are ahead of the curve in terms of breaking the law versus the regulators catching up with them. But those things don't tend to end well. So I don't. It's not sustainable, and you can also see that they're not getting a lot of traction, to be honest with you, because also a lot of the more institutional capital is not touching that space because they know that they are taking regulatory risks. So I just don't think it's long-term sustainable.
So on the other side of that, which is kind of like the Wild West, we have the big banks that are talking a lot about tokenization, but a lot of it is really restricted, right? So they don't allow withdrawals. A lot of it isn't even accredited only, it's institutional only. They don't touch Bitcoin, they don't touch stable coins. You can't do withdrawals. So, what do you think tokenization is? Like, if you have to define tokenization, I think my definition, I probably think a lot of what I see from the big banks isn't actually tokenization. It's probably something you could do on a spreadsheet. What do you think tokenization is?
That's a good question. Actually, the last few days, there's been a bit of a controversy online because, there is this website called rwa.xyz that publishes, and then they've started including things that a lot of people, myself included, do not consider tokenized assets, because these are just, I think they come up with the name of distributed versus represented, because yeah, I know it's a silly name. I actually was saying, like, well, what does that even mean? But my point is that they're trying to include as tokenized assets, these tokenized assets that are just represented on a blockchain, but that they could be on an Oracle database for that matter, because the fact that they're on a blockchain doesn't actually do anything. So I think that's, and by the way, I get that these large institutions are doing that because they're like, crawling before they walk and walking before they run. But we should not fool ourselves. That's nothing to do with tokenization. The promise of tokenization is that the assets are in a permissionless public blockchain where anybody can actually read and prove the ownership of the asset of somebody else, that you can transfer it, peer-to-peer to any other approved, recipient, that you can actually interact with, other protocols that people can actually build on top of it, because it's not a closed ecosystem, and that the openness of a public blockchain allows for, open innovation and people building, new features on top of it. So any of these assets that are sitting on these closed blockchains, in some cases they're not even blockchains, but just glorified DLT databases, I think that we should not consider those as tokenized assets. Those are okay. I mean, they're, helping educate the large TradFi people, and good for them. I think some of the people are focusing on doing that, so be it. I mean, I don't have any complaint, but we should not fool ourselves. That's not really solving any problem, and it's not solving the problem. This is, to me, like building, when the internet started, building American Online versus the open internet, right? people were building American Online. So, well, that's the internet. Well, that's not really the internet, because it's a closed ecosystem that only the approved participants can actually be there, that you don't have access to. Nobody can actually build anything, etc. And guess what? The open internet with open protocols is what took off and what flourished, because there was a ton of people, startups, etc., developing things, and that's what innovation happened.
No, that's what investors want. I think like people who are used to trading, Bitcoin denominated in USDT on Bitfinex, and you're trading it 24/7, 365, and you can pull it off and move it to your wallet. The people who are used to that, and then you go back to I'm in Taiwan, right? So we're 9 till 1:30. You sell your TSMC on Friday, you don't get your money until next week. Like that's what the investors want, is they want, what they have in the digital asset industry already. So
I agree. So if tokenization is just putting things on a slightly better database but not doing anything new, in my opinion, it is not tokenization, or it's not going to solve any problem, and nobody's going to care 5 years from now. This has to be about disrupting the market structure, being able to do different things, being able to leverage the advantages of a public ledger that is accessible by anybody, then anybody can actually freely build products, etc. So if not, then we're doing a disservice to the industry.
You mentioned liquidity earlier. That's part of the reason why you guys wanted to do a SPAC, is because there's just better liquidity in conventional markets still. And this is one of the questions that I often get from reporters too, is it because I think they think it's a bit of a gotcha question, where they're like, well, how are the liquidity, in the tokenized security space? And it's mostly not great. What do you think needs to happen for us to get more liquidity in the tokenized security space?
That's a good question. So obviously today, because these tokenized equities are not real tokenized equities, they're all these bearer derivatives, blah, blah, blah. The large market makers are not touching the space. And this is why you have such a bad liquidity, because market makers are not touching it, right? So you don't see Jump or Citadel or any of those doing market making.
Do you think it's also like the industry's bias towards fixed income? Like there's so much of the products in the industry are fixed income, and that's just like, not something that people trade.
So the crypto is built on yield assets, right? That's what people are chasing, yield, right? So today there's kind of like two ones. One is the yield bearing assets, which we have a range of it. So treasuries, credit, CLOs, etc. Those are great because in crypto, because DeFi invented basically a very efficient way of dealing with lending, where you take the asset, you post it as collateral, you borrow against it, you vend them, levered, etc. So I think that those assets work well with that part of the ecosystem, and we're very excited about it. And we have a range of products, and we're going to release more products that are yield-bearing products and try to get them as integrated as possible with DeFi. And the opposite end of the spectrum is the tokenized equities, right? Which today are very illiquid because they are not the real thing, and then the large market makers or trading platforms are not touching them, right? So can we build the same liquidity we have today in New York Stock Exchange or Nasdaq? Probably not. Can we build enough liquidity for that to be interesting? I think yes, but there's also other use cases, right? Like today, is if you talk about the the usage of collateral, margin, etc., then it's very hard to actually borrow against your Apple shares. Right? Like I go to Robinhood and I buy Apple shares and I want to borrow against it, and they will not borrow specifically about Apple shares. They just give me like a blended rate for across all my portfolio. And if I want to take the Apple shares and borrow with somebody else, then I have to move them. So it's very clunky and very inefficient, right? So lending is maybe something that is very interesting to do, that with tokenized equities, you'll be able to do in a much more efficient way. So not necessarily just trading in other places. And then international distribution, right? So US equities are not necessarily accessible in other countries. The same way that you guys have had a massive success distributing dollars, maybe the top of the pyramid that is already holding digital dollars want to hold digital Teslas or digital Standard & Poor's 500, right? So maybe it will actually serve that purpose. So
I think the other way too, I think a lot of like the whole developed world, I think, has pretty easy access to US equities through like, various, online brokerages and stuff like that. But I think also bringing global equities to the US and to mature markets, I think that could also be a big value add too. That's the whole reason why depository receipts were created, right? ADRs and GDRs for like Asian tech companies. is to bring those equities to the US. So maybe bringing global equities on chain and then bringing them to mature markets is another path.
Correct. And you could think of maybe a reverse ADR, right? where the tokenized version acts like an ADR for a US equity, or you could also do it native tokenization, right? So that's another option of basically pulling the shares outside of DTC and put them on a blockchain and then be able to distribute them, right? I think both are valid as far as you do it with the issuer, like as ADRs have sponsor ADRs and non-sponsor ADRs, right? And sponsors ADRs are usually the legit ones, the ones that people actually are buying because they know the issuer is behind. So I think that those approaches are good. But ADRs, Hester Peirce actually published an article saying if you tokenize a deposit, or if you tokenize and you create like an ADR on chain, then you're still creating a security, right? So you still have to follow the securities regulation. So that doesn't mean, now I can issue a permissionless token that can just fly around the world without any KYC.
So do you think, this is actually interesting, I just thought about this. Do you think that you will be the first publicly listed company to do a tokenized offering of their equity?
No, the first one was a company called Exodus, which is a crypto wallet that we actually did it with them. They actually did a tokenized offering of their equity before they got listed, and then they got listed in the New York Stock Exchange. And today they have securities that sit on DTC and then securities that sit on a blockchain outside. So, and this is the same securities. Like we manage them as a transfer agent, so you can move them back and forth between the TradFi database and the blockchain. And it's the same QSIP, the same security, the same rights, etc. Then other companies like Galaxy recently did something like that at a small scale, and of course we have now some of our customers and others that are the digital asset treasury companies that are very keen on this as well, that are doing this. So there's been a little bit of examples. I think we're going to be hopefully one of the first big ones, because we're going to really push for it and try to make it successful. But this is something that's been kind of brewing for the last few years already.
And what are the details beyond? Will you do it? Will it be open to US investors? What about global investors? Have you thought about doing it through like an offshore entity so that global investors could have access to it, and then maybe have something in the US for US investors?
We're going to do it through the US broker dealer, but it doesn't mean that it's not available to global investors, right? Of course, sanctioned countries, we block them, but anybody else can actually buy US securities through our broker dealer.
Sure. Yeah, that makes sense. Yeah. And we're talking about technology. What kind of chains do you guys support, and how do you evaluate which technologies to support? What are the kind of the features that you're looking for in technologies?
We support 10 chains. So we go through kind of like a process of, we've started with EVM, obviously we're an Ethereum shop from the beginning, but then over the years we've started supporting other non-EVM chains, obviously Solana, but also, Aptos and others. And then, we, not just for ourselves, but also for our customers, we have to do kind of a bit of a due diligence on the chain, like, what uptime, how decentralized it is, like things like that, just to make sure we feel comfortable with it, so we don't run into a problem because the chain is hacked or it gets reordered. Like what happened with Flow recently, like if my CTO was telling me, if we had securities there, what do we do? It's like suddenly you've reordered the chain, the last transactions have been wiped out because they've moved back to like a week ago. And so we have to be very careful with those things not happening to us, because then we're going to face a regulatory issue, because we'll have to figure out what to do with those securities transactions that have already been recorded in the books and records of either the broker dealer or the transfer agent, right? But we are largely chain agnostic. We think that this is going to be a multi-chain space. And we work closely with the Wormhole team to provide cross-chain compatibility and being able to move things from one chain to another. And that's the current situation. And I don't think that is going to change anytime soon.
But your kind of core requirement is that everything has to have whitelisting functionalities as well, right?
Yeah, the way we operate in every chain is the same. We will inject on chain information, non-personable identifiable information of the wallet. So we know the wallet belongs to a KYC user that is US based, that is retail or accredited or whatever, and that is good enough for our smart contracts to control the transfers. It's all decentralized, right? Like this is a smart contract. It's not me like as an entity sitting in between a transaction. So when you try to move one token from one wallet to another wallet, the smart contracts basically check all the boxes that, yes, can you do this? Because if it happens, it's a securities transaction. We basically update the cap table to reflect that something has changed on the cap table, right? So that has to be recorded as a lawful transfer of a security.
So maybe last question here, we're coming up on time. Looking out into 2026, what do you think some of the big trends are for the tokenization industry? What are the things you're most excited about? Maybe more equities, or more public companies issuing tokenized equity, or what are you looking for some of the more exciting things in the next 12 months?
So the equities, the tokenized equities, definitely, I'm very excited about it. And I think we're going to use ourselves as kind of like the guinea pig to show people what you can do with it. And also maybe on the regulatory front, there's a lot of debate about maybe getting some innovation exemption to be able to do certain things on decentralized protocols, etc. We'll see what happens and whether that happens and becomes a reality in 2026 or not. But definitely tokenized equities, and in general, we want to bring more retail products. I think many of the asset managers we worked with at the beginning, they wanted to start with more institutional products because they wanted to be conservative, right? And they wanted to be careful and mindful of not put products to retail, and also keep in mind that the regulatory change has happened only the last few months, 6 to 9 months since Chair Atkins took over the SEC. So I think that now that everything seems to be okay and the regulators are more friendly, and if you have a problem, they're going to talk to you, not sue you, which is the right thing to do. Which is fine. Like you might be doing something that it's not adequate, or you might have a problem. But if you think that you're going to be sued and that your company is going to go down to zero, then you're going to be much more careful. But if you think that the regulator is going to come and have a conversation with you so you can address the issue, that's a very different attitude, right? So I think that is going to allow us to basically push for more retail type products. And I think retail people so far have been left out of the RWA kind of boom in terms of consuming these products. So I'm very excited about that. I also am very excited about a better like DeFi integration for RWAs. I think that we've seen some of the early examples in 2025 with Aave Horizon and Morpho and Camino and other companies doing things in that direction. But I think we're going to see much more of that coming into 2026 and the confluence of DeFi and RWAs happening at a scale. So,
well, that's great, Carlos. I really appreciate the time today.
Yeah, it was great. Thanks for taking the time.